Welcome to Market Overtime on Schwab Network. I'm Diane King Hall. Today's guest has been one of the top tech stock pickers in recent memory, bringing his decades of experience to help him call the 2024 market rally and Cisco's rally last year. But entering 2026, he's warning that things may be different. Joining me now is Dan Niles, founder of Niles Investment Management, with his 2026 market outlook and his top 5 stock picks. Dan, it is great to have you back on Market Overtime. I love hearing your perspective, whether it's here on Schwab Network or elsewhere. As you know, I'm a longtime listener. So let's talk about the setup for this year. We've had a few years of momentum for the S&P 500. Let's talk broad strokes. What's your big picture outlook for 2026?
Well, I think it's going to continue where 2025 left off, in the sense that you're starting the year with easy money. And what I mean by that is the Fed in December switched from selling bonds to then they started buying $40 billion a month in short-term treasuries, so call it QE light. In May, you're going to get a new Fed president who's only going to be appointed by President Trump if he wants to cut rates by at least another 100 bips. So that'll keep the easy money going. And then you've got the tax benefits of the big, beautiful bill hitting in Q1, where consumers are going to get 100 to 150 billion extra in tax refunds, and then corporations will get favorable tax treatment on R&D and CapEx. And so I think you're going to see the year start off strong. It already has. The Russell 2000 is already up 8% for the year, which is pretty incredible. But I think as you get towards the end of the year, things are going to get a lot more choppy. I think you've got midterm elections coming up. The Socialist Democrats gain more seats, which I think people will be worried about. They're not considered as business friendly. And with multiples sitting up at 25 times trailing for the S&P 500, which is very high relative to where inflation levels are, and by other measures, even like enterprise value to sales, even higher than the peak in 2000, and the potential for the AI trade to get more discerning, which we've already seen at the end of last year, I think you could have a pretty big drawdown towards the end of the year.
Okay, Dan, let's get into what you mentioned about the Fed and your views on the Fed. So the Fed took the path that you expected last year in terms of the number of rate cuts. I'm hearing different viewpoints all over the place as it relates to how many the Fed will make this year, from 1 to 2 to potentially none. Where do you stand in terms of your expectations this year?
Well, I always like to say our job isn't to try to figure out what should happen. It's to figure out what you think or will happen. And think back to 2021. CPI started the year at 1.4%. It finished the year at 7%. And the Fed said, oh, don't worry, it's transitory. And the S&P was up 27% for the year. So do I think the Fed should be cutting? Absolutely not. Inflation's been above their 2% target for 4 years. But President Trump will put in a new Fed chairman. The only way that person's going to get picked is if he wants to cut rates by at least another 1%. And so you can do anything you want. You can say that inflation is transitory, much like they did in 2021. In this case, I think it's actually probably closer to being true. And so that just is going to keep the rate cuts coming. And the market, to your point, Diane, is trying to be rational and say, well, really, we shouldn't have that many. But it doesn't really matter that we shouldn't have that many. If we get them, that's just going to keep flooding easy money into the market, and that's just going to drive stocks much higher, because inflation is bad for the 50% of the population that doesn't own stocks, but it inflates everything from real estate to stocks to crypto to you name it. And I think, unfortunately, that's what we're going to get, which is why I think as you get towards the end of the year, it's going to get a lot choppier, because you're going to be dealing with the after effects of that, much like you did in 2022 when you did have to deal with high inflation.
Let me ask you this, Dan. I want to dive into inflation a little bit more in a moment, and how much that matters and your expectations for that. But I want to ask you a question about the Fed and the independence of the Fed, and how much that matters now, especially given the expectation that whoever is Fed chair next will likely continue the path. Honestly, it seems like no matter what of rate cuts. But how much does the independence of the Fed matter to markets?
I mean, it should matter to markets, but I think the bigger thing is what the Fed actually does. Because you can say the Fed was very independent in 2021, and they screwed up colossally, right? They thought inflation was transitory, and we instead had the worst inflation in 40 years. Like, that's a gargantuan miss.
Hmm.
So I think you have to focus on what the policy is going to be. I think the day that it came out that the Justice Department might file criminal charges against Fed Chairman Jerome Powell, the market, I think, actually finished up that day, if I remember correctly. So, should the market care? Yes. Does it care? No, because it's focused on the fact that, oh, well, if the Fed is going to keep giving us easy money, then hey, stocks are going to go even higher. And that's ultimately what investors focused on that day versus the Fed having more pressure not to be independent.
Okay, I want to talk a little bit more about your inflation expectations. So we recently got a CPI print that essentially came in line with expectations. Shelter is still sticky in terms of where inflation is. So, you don't have inflation really accelerating, but you don't have things exactly cooling. What are your inflation expectations this year?
I think they're going to stay above 2% because it's very hard to see with where services inflation is and how much average hourly earnings are up year over year. I think they're going to stay above 2. I think the Fed, for their part, has shown that when faced with the decision between inflation or low growth, and let's be clear, AI is great for productivity, but it's not great for employment. And so I think you're going to see a lot of pressure on the labor market as you move through this year because of that reason, where you're sort of in this low firing environment, but you're also in a low hiring environment. And so I think inflation stays above 2, but the Fed cuts anyway because that's what they want to do, and regardless of whether that makes sense. But that's also why, to be clear, much like in 2022, you had the stock market go down 19% after that increase of 27% in 2021. That's why I think the back portion of this year is going to be choppy, because you're going to have to deal with some of what you're doing in the first half, which is probably overheating the markets.
Hmm.
You're going to have to deal with that as you get towards the end of the year, combined with the political landscape.
I want to go back to a term that you mentioned. It was a hot button term for a while, but it feels like we're allowed to use it again, transitory. And I want to tie it to tariffs, right? The view, I know, remember it was such a, it was like we cannot use that word anymore. But now we're back to using that word. Markets seem comfortable assuming essentially that tariff-driven inflation is transitory. But what if the market is wrong? What would make you say, no, this is not transitory, this is structural?
It's really, the way I always say it, it's never the data. It's how the market reacts to the data. Because I remember in 2021, I was on, had numerous interviews where I'm like, there is zero chance this is transitory because services inflation is so high, and services is over 70% of the US economy, and you have twice as many job openings as people unemployed. So there's zero chance this is transitory. But the market just kept climbing because that's what people wanted to believe. So I think what you're going to have to do is wait for the market to kind of acknowledge that this is becoming a problem. And right now, what it's really focused on is, the Fed spiking the punch bowl. And that refers back to this old phrase of the Fed's job is to remove the punch bowl once the party gets started. But they're actually spiking the punch bowl right now by starting QE light and then in May getting a new Fed president. And so you'll find out when the market's overheated, when it starts to really get concerned. And watching the 10-year treasuries is a good place to start, in the 2-year treasuries. You'll kind of see the footprints of people going, well, maybe inflation is not as transitory as we thought, and maybe this is a problem when you combine it with deficits that are continuing to be negative and the fact that valuations are high. And maybe you've started to see some of that because we haven't talked about AI, which I'm sure we will.
We will,
But
yeah.
the AI trade to some degree now is being fueled by this easy money because even the biggest companies in the world are hitting the debt markets to borrow. And we start talking about credit default swaps again, right? As it relates to
Wow.
Oracle, for example.
Yeah.
And so all of these things are becoming much more intertwined right now, which is why the Magnificent Seven as a group are down about 1% to start the year, even though the Russell is up 8% to start the year. And obviously, the whole AI trade has been the biggest driver of the market for the last 3 years. But you could argue now it's also dependent on debt fueled financing.
Okay, Dan, I'm glad you brought up AI because, towards the end of last year, I feel like we were having that conversation about bubble. Throughout the year, we were starting to have that conversation about is it a bubble, is it not a bubble? And then there was, some questions about the monetization of AI. Now that we're entering basically year four, you mentioned 3 years in, we're entering year four of the AI cycle. What is the market looking for? Is this about, monetization here? Is this the year that is where we start to have to see more material numbers around that?
Absolutely. And I think it's not just monetization on the top line, which I mean, it's not just revenues, right? It's going to be profitability and cash flow. And a good example of that, I think, is Oracle, where if you look at Oracle when they reported in September, the stock was up 36% the next day because they had a huge order from OpenAI for about 300 billion within that bookings number of I think it was like 455 billion. And the stock was up 36% the next day. It was the biggest one-day move in history for any company with a market cap of over $500 billion. Since then, the stock's come down over 40% because then people went, wait a minute, how's OpenAI going to pay for this? Because they're doing only 20 billion in run rate revenues exiting 2025, but they're anticipated to burn 150 billion in cash flow before they ever turn positive, and they've got capital commitments of 1.4 trillion. And so all of those things really starting at the end of October started to influence how a lot of these stocks traded. And so I think as you get towards the end of the year, to your point, Diane, we're going to find out that not every company that thinks they're going to do great in AI is going to win. And I've said, if you look at the aftermath of the internet bubble and you think about that, you go, well, how many winners were there in search? Well, one, Google. Well, what about in e-commerce? Well, there's really one, Amazon. Well, what about in social? Well, there's only one, really. It's Meta. Streaming, Netflix, audio, Spotify. But if you look at AI, the assumption is, well, all these guys are going to win. That's probably not going to be the case. I think Google's going to turn out to be the winner in consumer AI. And then in corporate AI, obviously Microsoft's got a hammerlock on corporations. Anthropic's doing very well in terms of the private companies. And you've got Oracle that's got a hammerlock on databases for Fortune 500 companies. But if you say, well, generally there's been only one winner, that makes it kind of tough to think that everybody is going to win. And so I think you're going to see a real shakeout happen towards the end of the year based on not just monetization, as you rightly brought up, but the profits you can generate from underneath that to fund this.
So I hear your point. I hear you. There are going to be winners and losers, obviously, but I don't think it has to be a zero-sum game. I think there will still be, some who are at the top of the leaderboard. When you think about those who could potentially be the laggards, who's most at risk when the narrative flips around AI?
Well, that's easy. That's OpenAI. I mean, for one simple reason, 75% of their revenues come from consumer. And there's 5 billion consumers daily that have been trained by Google that you get answers for free. So it's going to be very hard for them to get consumers to pay for this, especially when Google has shown with Gemini that they're doing a really good job of delivering a top-ranked model They have the monetization engine with search. They've got the end consumer products through Android and their own Google Pixel phones as well. And then they have Google Cloud also to help monetize that infrastructure spend that they have. And so they really have all of that. Plus, they've got an incredible cash flow machine to fund all of this. And so that makes OpenAI's positioning very tough. And as a contrast, Anthropic gets about 3/4 of their revenues from enterprise. So very different. Enterprises obviously used to paying for things, and they're doing quite well there. And so I think OpenAI has got the most risk to it just because of where they're positioned and going after. I'm not saying it's not a fantastic company. It obviously started the AI revolution. I just think Google's an even better company, and it's going to be very tough for them to compete against Google. And I think that's what you've really seen since the peak in October.
Okay, so in 2025, there was this bifurcation within the Mag 7, right? You had Alphabet, Google, all the way at the top, rising more than 60% last year. Lower on the list is one of your picks. You like Apple. What is it about Apple now? Because there was all this talk about the super cycle. When was it going to come? It does seem like it came last year with the 17, but where do you see it now? And what's the catalyst from here to drive further growth?
Well, I think to some degree, because they've been so pitiful in AI, that's the catalyst to drive growth. Because, the stock was only up 9% last year. They've had, and before that last year, they had a combined growth of 1% over the prior 3 years before that of revenue growth, which is absolutely pitiful. And so if you look at what's coming, though, at the end of this year, you're going to get a AI-enabled Siri on a foldable phone that's going to come for this upcoming Christmas cycle. And if you go back through time, the biggest upgrade cycles have happened around form factor changes when you get a bigger screen. So if you look at the iPhone 6, for example, when you went from a 4-inch screen to a 5.5-inch screen, revenue growth went from 7% in fiscal 14 to 28% growth in fiscal 15. And so that's why I think as you get closer towards the end of this year, people start getting excited and go, finally, I get an AI on my Apple device. And in addition to that, I get a foldable phone, which, by the way, Samsung has had one since 2019. So that shows you how far behind Apple is. And I think that's going to lead to a very nice upgrade cycle, which thankfully at this point, most people have given up on, just given how poorly Apple has done over the last 3 years during this AI boom.
Well, I will say I contributed to the upgrade cycle after several years. I finally got a new one, joining the 17 family, along with another in my household. Let's talk about Cisco. It was a winner last year. You like it in terms of, you said, keep riding the AI wave. What continues to fuel your conviction around it in 2026?
Well, the reason I picked it for last year, so a year ago when I gave the thesis, it was, look, I think they're going to show that they're a credible player in AI. And Cisco's revenue growth for the prior 5 years before last year was 1% per year on average for 5 years. So that's about as bad as you can get. Last year, that growth for fiscal 25 accelerated to about 5%. This year, I think it can accelerate to the high single digits. But when you look at the multiple, you go, wow, it's only trading at a high teens PE, where the S&P is trading at 22 times forward. And so if you think infrastructure revenues related to AI go from about $1 billion last year to closer to $3 billion this year, I think that continues to get people interested, because from a big picture basis, you're generating all this AI data. Well, corporations need to get access to that, and so they're going to need to upgrade their networks. And the last big upgrade happened during COVID. That was about 5-6 years ago. And so it's about time also for an upgrade cycle for enterprise. And so those two things are hitting simultaneously.
Okay, let's talk about another one on your list. This is outside of the AI space. This one's Boeing. I love big backlogs, and I cannot lie. I like that, how you characterize that, the call out to Sir Mix-a-Lot. Tell us about how you see Boeing this year. It had a very different year last year from the prior year. I'm sure some investors were breathing a sigh of relief after several years of pain for Boeing. Where do you see it going this year?
Well, I think number one, congratulations for recognizing where that phrase comes from.
Yes.
But if you look at Boeing, the big difference is in September of this last year. Remember, they had that horrific crash in 2019, and so they've been under massive regulatory oversight. September of this past year, they had limited authority to start self-certifying their planes. And so now you can really start to crank up the shipments of these planes. And they had negative 2 billion in cash flow in calendar 25. I think that improves to low single digit billions of positive cash flow in calendar 26. And that should grow to close to 10 billion before the end of this decade. And that's not a hard bar to clear because they were doing about 14 billion in calendar 18. So I think with that momentum really picking up, that's going to help Boeing continue to re-rate. It's already had a great start to this year, and I think it's going to continue to gain momentum. And let's not forget, a quick way for any country to fix a trade deficit problem with the US is to buy Boeing airplanes because they're so expensive. And you've seen that with a lot of the trade deals. So that's an extra kicker on the side. And obviously they do defense as well. And clearly the geopolitical climate has gotten a lot more interesting, let's say, over this last few weeks.
All right, let's talk Nike. It's on your list. This is the one I knew your list obviously ahead of time. This is one I have questions about. Elliott Hill's working on a turnaround there, obviously. But if you bought this stock 10 years ago, if you go back to 2016, 2015, you're not super happy with how it's performed. How long before you lose patience, and why do you like it here for this year?
Well, let's be clear. I liked it for this year. I didn't like it last year. So
Okay.
there's a couple of different things. So the first thing with a turnaround is you go, is there something fundamentally wrong with the company? And if you look at the brand globally, it was the 10th ranked brand in the world at one point. And when they brought in the old CEO, he was from eBay. And he changed the strategy and he said, look, I'm from eBay. I want to take the company more to a direct model. It was the wrong thing to do. And you saw the global brand drop from about 10 into the high 20s. Elliott Hill came in about a year ago. He's a 32-year Nike veteran. He started as an intern at Nike. He said, look, we're going back to the basics. And our basics were we were focused on sports. We were focused on having a strong retail presence. And that's what we're going to get back to, and an innovation of our products. And if you look at what's happened now that he's been a year into the job, in the US, 2 quarters ago, revenues were down about 11% year over year. This most recent quarter, they were up 9%. So it's already starting to take effect in North America where things are changing. I think you're going to next see a turnaround in Europe. And then I think China is the hardest market for them. That'll be last on the list. But where's the valuation? Well, everybody, to your point, has looked at this and gone, the stock's where it was a decade ago. Why would I own this thing? And that's why the enterprise value to sales number is at the lowest point in a decade, excluding the tariff-driven drop that we saw, earlier last year. And so you're getting a very good brand with a credible way to turn it around where you've already got some evidence in North America that it's working at a low multiple. That's what you want to have. And in some ways, it's my Cisco pick for this year, in that this is exactly how Cisco looked a year ago, where rightly it had been given up for dead, just given how poor its growth had been over the prior 5 years.
Yeah, I mean, I hear what you're saying, part turnaround, part valuation story here. And listen, my heart certainly roots for Nike because, listen, I came up with Nike. But it's hard to see, especially even when you do the kind of sentiment test and you see what people are wearing. But I don't want to count them out. I remember the Just Do It. It's the Michael Jordan name. We'll see if this is a comeback story this year. Let's talk about the last name on your list. And you'll have to correct me because I'm not as familiar, if I'm wrong on the pronunciation, Impinj, ticker Pi. You like this one. You say the time has come. Tell us about this, and just for those who aren't familiar with this company, what it does.
Sure. The name of the company is Impinj, and they have this they're the market share leader, over 50% share in this technology called radio frequency identification, or RFID for short. And if you look at this technology, much like the internet or AI technology, which had been around since the 50s and 60s, so has RFID technology. But I think you've gotten to the point where you're hitting an inflection. And why? Well, their new chip that they came out with, the M800, lets you get the cost down to about a penny a chip. And what does that do? Well, that enables you to start tagging pretty much everything. And the everything in this case that matters is food, because that's what the biggest units are. So the current market for RFID chips is tagging things like, Nike sportswear, but the apparel market's only about an 80 billion unit a year market. The food market that they're entering is over 1 trillion units a year. And so you're about to hit this inflection point where you've got the biggest companies in the world. Walmart in the United States has adopted this for food, and they do 20% of the groceries in the US. You've got Kroger's, which is the biggest pure play grocer in the world, who's also adopted this technology. And so I think when you look at this company over the next 5 to 10 years, it could have one of the best profiles in all of technology, just because you're moving from a very narrow market in apparel to the biggest end market in the world, which is the food category. And that's going to start to ramp up as we go through this year.
Okay, Impinj, thank you for that. Ticker PI, P-I. I want to run back out for a little bit. We're closer to all-time highs than not. I guess I want to frame it this way. Given what you said about where we may land at the end of this year, are we at the peak of optimism at the beginning of this year, and kind of, should we have more measured expectations for how we finish this year compared to the past few years?
Well, I just try to focus on the market right in front of me. And, there's this old saying by John Maynard Keynes that the market can stay irrational longer than you can stay solvent, right? And so for right now, my view is, well, I've seen what easy money can do to markets. And we saw that in 2021, right, where markets ignored inflation, S&P's up 27%. We had a global pandemic. But because of the easy money that year, the S&P was up 14%. Why? Easy money. So I look at what's going to be happening to start the year in the first half, and I go, we're going to get a ton of easy money, and there's nothing to say that we can't have a huge first half of the year. And you're already seeing it in the Russell, right? It's up 8% to start the year. That's incredible. And that means it's a broad-based rally. The S&P is up about 2% to start the year. The equal-weighted S&P is up 4% to start the year. The Russell's up 8%, which is even broader, and that's despite the Magnificent Seven being down to start the year on average. So that just tells you what all of this money is doing, despite, we go in, to Venezuela. Well, what's going to happen with Greenland? What about Iran? Nobody cares. Why? Because the party's still going. I've got all this easy money. And so if the market can go up despite all these geopolitical things going on, what happens if some of that settles down? And that's why I think I am really concerned about the back half of the year, because there is no free lunch. You keep driving valuations up, and eventually you have a problem. And let's not forget, in 2022, the Magnificent Seven on average were down 46%, with the market down 19%. So you can enjoy the party, but when it ends, it can be an ugly end.
Oh, that's a good point. I hate to end it there. I guess we'll enjoy the punch bowl while it lasts. All right, we will have to leave it there for time. That is Dan Niles, founder of Niles Investment Management. Thank you so much for bringing your 2026 playbook, expectations, risk ahead. And thank you for joining us on Market Overtime. For more episodes, follow our YouTube page and be sure to watch us 24/7 at schwabnetwork.com.